Hello, this is the presentation regarding the recording and compiling of accounting information, and in order for me to explain this process, I need to try to explain the accounting equation in the balance sheet. And in order for me to explain the accounting equation, I need to repeat once more the structure of the balance sheet, the very basic structure. Okay, so we have here in front of us the accounting, the T account as we call it, that is actually the balance sheet. So on our right hand side we have the equity. The equity, as we said earlier in this course, actually represents the internal sources of company capital, the money that the owners contribute to the company in order to become owners in this particular entity. So if you think of it, the owners give money to the company, they contribute money to this company in order to acquire some things for the company's assets. So they use this money in order to acquire, let's say, the machinery, medical equipment, lab equipment, in order to start producing, in order to start offering their services. So they actually use these internal sources of capital, this contributed money from the owners, in order to acquire assets. But if you think about it for a second, just by contributing money, the owners I mean, it's in many cases quite difficult to acquire all these assets. They're very expensive. So here comes the part of liabilities. The liabilities are more or less, they represent the external sources of company's capital. Since it's very difficult to acquire all the assets that the company needs in order to operate, we need some external sources of money. For example, from a bank. So we use both these external and internal sources of capital, the liabilities and the equity, in order to acquire assets. So the trick here, in order for me to explain the accounting equation, is that these two parts, the sources and the uses of company's capital, need to be equal. In order for me to explain it a little bit better, let me try to show it in a simpler way. You can see here that we have A equals L plus SE. The sources of financing for economic resources, the sources of financing for acquiring assets, the liabilities and the equity, are equal to the economic resources, that being the assets. So this accounting equation always needs to stick. It's always a prerequisite for everything in accounting. Now, in order to introduce the concept of recording the various accounting transactions, we have to explain how these transactions are created. They are created either due to external events or internal events. We might have external events which have to do with exchanges of assets and liabilities between the business and one or more other parties. For example, we borrow cash from the bank. So here we have an exchange, or we actually pay some money, some of our cash, in order to acquire some raw material, some supplies from our suppliers, and so on and so forth. While for the internal events, we're actually we're not discussing about an exchange between the business and other parties, but they have nevertheless a direct effect on the accounting entity. For example, we have the loss due to fire damage. This is not an external event. It doesn't have to do with a transaction per se, but still it's an accounting event that needs to be recorded somehow. So, how do we record everything? We record everything using accounts, as we have seen previously. We use an organized format that most of the entities use in order to accumulate this monetary effect of transactions. So we have this organized format based to these generally accepted accounting principles, and this is known as accounts. Every account has various sub-accounts, smaller accounts, that describe every single transaction taking place in every entity. In most of the cases, this organized format, it's organized, but still there's some liberty in how we can use the various sub-accounts, the names that we can give them. So don't be stressed about whether you understand completely or you remember completely the names of each of the accounts. Some of the most widely used categories of accounts are cash. We're talking about cash that are either in our vaults or in our deposit accounts. We're talking about equipment, medical equipment, machinery, things like that. or even if we're talking about factories, if we're talking about the property that we have in our disposal, and so on and so forth. We also have the inventory of supplies, or the notes payable. These are liabilities that have to be paid to third parties. Every little bit of day-to-day activity is being recorded into a particular account that has some kind of value. So every accountant and every other interested party into this particular company can go and see what is the particular account and what is the respective value of this account, in order to use it for his own analysis, in order to get information of the financial health of this entity, and so on and so forth. Now, the typical account titles for the balance sheet, as you can see, are actually structured in the balance sheet according to the basic structure of this financial statement. So we have the assets, for example, cash, short-term investment. It's quite self-explanatory. We're talking about investments that are for less than a year period. We're talking about accounts receivable and notes receivable. They're more or less the same thing. We're talking about some money that other people owe us. The inventory, things are to be sold, various supplies, medical supplies, for example, long-term investments, investments that are made for more than 1 year, for example, buying stock from another company, the various equipment, the various buildings, the land in which we have, for example, the hospitals, and the intangibles like, let's say, patents, like know-how, like trademarks, and so on and so forth. On the other hand, we have the liabilities. The liabilities are, as we said, the part that has to do with external sources of financing our company. So we have other people, other parties in which we owe money. We have accounts payable, notes payable, obviously taxes payable, the taxes that we owe to the government, bank loans, and so on and so forth. And obviously, last but not least, the stockholders' equity. We have the contributed capital by the owners and the retained earnings. Very important for this particular, the last account, it is for us to understand it a little bit. The retained earnings have to do with the money that are left as profit from the previous year. So, at the end of each fiscal year, the company makes some money, makes some profit, hopefully. So, in every case, some of this money are given back to the investors, to the owners, for their contribution to the particular company, and some of them are kept as retained earnings in order to be used in the next year for various investment purposes and so on and so forth. So the retained earnings play this particular role. So how do we end up understanding and having this net income, this profit that we're talking about? It comes from the income statement. The income statement actually gives us the net income, whether we have profit or we have loss. So how do we end up knowing whether we have profits or losses? By actually having revenues minus expenses. So revenues also has the revenues classification also has specific accounts, and the same applies for expenses as well. We have here the revenues, with the sales revenue, the fee revenue, the interest revenue, revenues coming from various deposit accounts that we have in the banks, the rent revenue, when, for example, our entity owns some land, for example, or some buildings, and we actually rent them, and so on and so forth. On the other hand, we have the expenses, cost of goods sold. Cost of services sold might be in the case of a healthcare entity. The expense from wages, coming from wages. The expenses from rents, when we rent some property in order to have, let's say, our clinic. The interest expense, the interests that we pay for, the expenses that we have as interest that we pay for various bank loans. The depreciation expense, here I'm going to stand for a second, try to explain a little bit. This is a very particular expense because it has to do with the depreciation of assets value. Let me try to explain it for a second. When we're talking about depreciation of an asset's value, we're actually talking about an asset that is losing value due to its daily use. Imagine that you buy, let's say, a car. Every day according to its mileage, obviously some damage is being made. It needs some service and so on and so forth. It's never going to be as good as new. So it loses value day to day due to its use. It depreciates its value. So we need somehow to record, to represent this depreciation of the asset's value in our accounting statements and our financial disclosures, and obviously in these accounts. So we use this depreciation expense to show this in the financial statements and in our accounting records. The advertising expense, the insurance expense, whether we have something insured or not, the repair expense, and obviously the income tax expense. Now, in order to show you how this transaction is being recorded, we need to try to state the basic principles of transaction analysis. Every transaction that happens affects at least two accounts. This is known as the duality of effects. So in every case, when we have a transaction in day-to-day activities, at least two accounts of the ones that we have mentioned is going to be affected. And obviously, we always have to keep in mind that the accounting equation must remain balanced after each transaction, meaning that assets have to be equal with liabilities plus equity. Most transactions with external parties involve an exchange where the business entity gives up something but receives something in return. For example, when we buy something, we obviously give cash and we get this product in return. So we have this kind of exchange that always needs to be kept in mind. And this is how the duality of effects when we record something works. So how this works, how do we record it? Let us try to break it down into steps. We have the first step being accounts and effects, identifying the accounts and the effects, and the second step, which is the balancing. So the first step has to do with identifying the accounts affected and classify them by the type of account, whether it is an asset, a liability, or an equity. And secondly, to determine the direction of the effect, either we have an increase or a decrease on its account. The second step is all about balancing. We need to verify that the accounting equation remains in balance at all cases. So let's try to take a small example in order to depict exactly that. Assume that we have St. Lucas Hospital issues 2,000 euros of additional common stock to new investors in order to acquire some cash. Let me try to explain a little bit better. So here, St. Lucas Hospital needs some extra money. So it actually asks for more investors, for more owners. And it issues 2,000 of additional common stock to new investors. What will happen? First of all, when the new investors will come, we'll provide some extra cash. So this cash are going to be are going to be introduced to this entity. So cash will come into the company. And secondly, this cash means that some new owners are going to contribute capital and become owners. So equity is also going to be affected. So we have two accounts that are being affected by this. Cash that are going to come from this additional common stock to new investors, and also equity, which means that new owners will introduce themselves to this entity. What is it going to be the direction of the effect? Obviously, cash is going to be increased. It's going to appreciate. We're going to have more cash in our company. Why is that? Because new owners are going to give their money into this particular company. And at the same time, the equity part is going to be increased as well. Let us see how this works. So here we have always, you can see here that on the left-hand side, the more green table represents the asset section, while the other one represents the liabilities and the stockholders' equities. Here we have the liabilities, and here we have the stockholders' equity. So here you can see that we have 2,000 euros coming in the company as assets and in particular as cash, while in the same time we have the contributed capital being increased by 2,000. So you can see that we have a complete equation again. 2,000 in cash, 2,000 in the notes payable, the contributed capital. So we have 2,000 for assets, 2,000 for liabilities and stockholders' equity. Let me give you another example. The hospital borrows 6,000 from the local bank, signing a 3-year note. So in this case we have obviously, since the hospital borrows money, obviously we will get some extra cash in the company. So this is why we have the cash that is being affected, and actually it increases, while at the same time we have a liability towards an external contributor. Someone else gives us money. We borrow money from someone else, and this is represented through notes payable. So notes payable is going to be affected as an account, and actually it's going to be increased. In other words, we have a cash, the cash account that increases, and the liability account, which is notes payable, that is going to increase. So again, we have the same structure. You can see here that we increase in 6,000 for assets in terms of cash, so we have 6,000 more cash that we borrowed from the bank, but at the same time we also have a liability, money that we own to someone else, equal to 6,000 euros. So this again we check for the account balance, and we can see that we have 8,000 in the asset section, 8,000 in the liabilities and stockholders equity section. Finally, for the St. Lucas Hospital purchases, we have another example. It purchases 10,000 euros of new equipment, paying 2,000 in cash and signing a 2-year note payable for the rest. So we have a more complex transaction here taking place. Again, we have to identify and classify the accounts. Let us take it step by step. We're saying here that it purchases 10,000 of new equipment, so we have new equipment being affected as an account, paying 2,000 in cash, so we have the cash being affected, and signing for the rest a 2-year note payable, so for the rest 8,000, a 2-year note payable, so we have this account affected as well. What's the direction of the effect? We have the equipment that increases. Obviously we're buying a new machinery, and how do we buy it? We pay 2,000 euros in cash, so our cash decreases, and we also pay with a note payable. We create a new liability for the rest. So you can see that we have a new liability, notes payable in the particular case, that increases. Let us see this example once more, and you can see here I have 2,000 being into brackets. This means that it's a negative price, a negative value. So here you can see that our cash are being depreciated. We have a decrease of cash by 2,000. We gave 2,000 for cash. We increase in assets again by acquiring a new part of equipment, 10,000. So we have in this asset section 10,000, while for the rest we sign a 2-year note payable. Here we have an increase in liabilities. We owe some more money for this equipment over here, 8,000. So if we add this up, we have 16,000 euros for our asset section, since we have 2 plus 6 minus 2 plus 10,000, and 16,000 for the liability and stockholders equity section. So we have an equality here, the accounting equation being valid once more. In general, if we want to sum this up, during the period we analyze transactions, we see them, we try to understand how to figure out how they work. This happens constantly in day-to-day operations. We record journal entries in the general journal in order to have a record of what's happening in our company, and we post these amounts to the general ledger. So this allows us for complete information. So at the end of this period, we adjust our revenues and expenses, and obviously the related balance sheet accounts. So we take all these transactions and we actually somehow adjust them in order to give us, by the end of the period, the net income, either the profit or the loss of the particular period. And we use all this account information to prepare a complete set of financial statements, and we disclose these statements to the users. And after that, we close the revenues, gains, expenses, and losses. We take this and we transfer them into the retained earnings. This is a far more advanced accounting topic, a more advanced topic that needs to be discussed later on. In general, this procedure is being done with journal entries, and the recording is done in what is known as T accounts. So all this recording of the journal entries, all this recording of the day-to-day operations, but also at the ending of period transactions is being recorded into the T accounts with journal entries. So let me try to explain how this works for a second. So we have here a T account. It's actually called a T account because it has exactly this shape. It has the shape of a T account. So this T account is being used in order to record this dual effect of each of the accounting transactions. On the left side of the T account, we have always the debit side. On the right side of the T account, we have always the credit side. So if a specific account is being debited, we record this debit into the left hand side, while we record every credit on the right side. Now, in order to explain this a little bit better, let's agree on some basic rules, because obviously we need to understand when we credit and when we debit something. So we have three parts, three classes, three categories of rules. First of all, we have the category of rules regarding assets. An asset, it is debited when it increases, and it is credited when it decreases. This is something that we have to learn by heart. On the other hand, when a liability increases, it is credited, while it decreases when it is decreases, it is debited. So we have the exact opposite. And finally, for the equity, the same thing happens as with the liabilities. We have an increase for a transaction. This means that it is being credited. We have a decrease for a transaction. Then that will mean that this is going to be debited in the respective T account. And finally, when we're discussing about expenses and revenues that have to do with the income statement, we have the expenses to be debited when they increase, or being credited when they decrease. The exact opposite happens for revenues. So as you can see, we have the exact same behavior towards assets and expenses, and the exact same behavior towards liabilities, equity, and revenues. Use the color code in order for you to remember. Now, in other words, in the T accounts, we have debit for increase in assets and credit for decrease. In liabilities, we have debit for decrease and credit for increase. And in equity section, we have debit for decrease and credit for increase. Let me try to explain you how this works with a real life example. We mentioned the last example about the St. Lucas Hospital and the purchase of 10,000 euros of new equipment, paying 2,000 in cash and signing a 2-year note payable for the rest. So we have here the assets. We said that the St. Lucas Hospital paid 2,000 in cash. So you can see here that since this decreases, where we actually pay 2,000 euros, this is going to be recorded on the right hand side as a credit. At the same time, you can see that in assets are being increased. So we buy a new asset. And what did we say? That when assets are going to be increased, we're going to debit them. So here you can see that we have the assets being debited with 10,000 euros. While for the liabilities we have a new notes payable. So we increase the liabilities. What happens with the liabilities? When we have an increase in liabilities, here you can see we increase it. So, we credit it. So this is why we record 8,000 in the credit section. And the journal entry might look like this. Here, for example, we have a very simple structure. We have the three accounts. We have a reference, lender, number, or date. In most of the cases, we use dates. We have the account titles, property and equipment, for, in our case, the 10,000 euro new equipment, the cash. So we have an increase in assets, a decrease in assets, and an increase in notes payable, so the liability. And we have the debit and the credit, and it goes always like this. We have a debit on the left and the credit on the right. So we have 10,000 as a debit and 2,000 for cash and 8,000 for notes payable that are being increased. So we have a debit of 10,000 and the credit for 2 and 8,000. If you add them up, you will see that we have 10,000 as debit and 10,000 as credit. After journal entries are prepared, the accountant posts, they transfer the monetary amounts to each account affected by the transaction into the general ledger. And this allows for a very detailed recording and compiling of the data.